So how exactly do we allocate income to the different partners? And it's not always and usually not 50-50. Partnership accounting, the techniques involve allocating income according to the profit and loss sharing agreement, that initial contract between the partners. Now, if no agreement exists in writing, then the split must be equal. The different ways to allocate income, it can be based on beginning year capital balances, it can be based on services performed, or what's called stated ratios, or it can be a combination of multiple methods. So to review again, thinking of you've already closed revenue and expense to income summary, so you have a net loss or a net income, and that needs to be allocated according to the agreement to the different capital accounts. Remember, with a partnership, you'll have more than one capital account and more than one drawing account. Now, when we look at capital balances, this is sometimes called an interest allowance. It is not an expense. You will not be recording interest expense for this allowance. It's just a way to divide up net income or net loss between the partners. The allowance is income allocated to the partner for their initial capital investment. Now remember, a partner is not an employee, they're an owner. And the owner is going to receive an allowance. It is not real interest. It's not interest revenue. It's not interest expense. It's just a percentage of income based on whatever the partner's initial capital balance was. Now, if the allocation is based on services, work that they're performed, sometimes instead of an interest allowance, this is called a salary allowance. But again, it is not salary expense. Salary allowance, that's a way to divide up or allocate income to the partner for the actual work they performed or should be performing. And again, a partner is not an employee, so you will not have a salary expense. It's just a way to divide up income. The owner receives an allowance, not a real salary. And what if I want to use stated ratios? This is usually for what remains after the salary and interest allowance, although the agreement could be entirely based on ratios. And it can be presented many ways. It can be 2/3 to one partner, 1/3 to the other partner. It could be stated 5-4-3, just a different way to look at it. Or it could be 50-50. That's okay too. It's just a way to allocate net income or loss, and there may actually be a negative balance that remains after the salary and interest allowance. Don't worry about that. This is just how you divide up the money. You're going to use stated ratios to divide any positive or negative remaining balance after any allowances to divide that income. So we're going to look at an example. Let's say we have Maria Rock, David Binder, and Ross Selker. They have initial capital balances as of January 1 of the current year of these amounts, $47,840, $64,400, and $71,350. Now at the year end, the firm actually earned $342,000 of net income. So how do we split this up? No agreement exists for sharing income or loss. So if you remember the rule, if there's nothing in writing, it must be equal. So you would divide it up 1/3, 1/3, 1/3 for each partner, and that's going to close your income summary. Okay, now let's say, per the P&L sharing agreement, there is an interest allowance of 20% to Rock, 15% to Binder, and 20% to Selker. The remaining is to be shared equally. So what does this mean? Well, you look at the initial capital balances, and you multiply it by those interest allowance. So based on 20% for Rock, 15% for Binder, and 20% for Selker, it's the percentages of what their beginning year capital balance is, not the end of the year. If it was the end of the year, then a partner could kind of manipulate things towards the end of the year. If they see a huge income come November, they could take some money out of their personal savings to boost their capital accounts to get more of the income. And that's not fair to the other partners. So that's why the rule states it must be beginning capital balances for the year, because you really don't know what's going to happen throughout the year. So total interest allowance is based on this example, $33,498, but you had a total net income of $342. So after subtracting that, what's left? And with this agreement, this example, the remaining after the interest allowance is divided equally. So you take the interest allowance plus that equals split, and it should equal your net income. Always double check your numbers. So this allocation is very close for the three partners. Selker's getting a little bit more. And this is your journal entry. Now, if it was a net loss, it would be opposite. You would debit the capital accounts, the three capital accounts for these amounts, and credit your income summary, just as you learned in Accounting 121 of the closing process. Okay, now we're going to add a little to this problem, another example. Same P&L agreement, except now there's also a salary allowance of $20,000 for Rock and Binder and $35,000 for Selker. So why would a partnership come up with an agreement like this? Perhaps when they started the business, Selker was going to be the managing partner, doing most of the work. So it's best to set up a chart, and there may be some examples you can look at your textbook. So we have total net income, and then we're going to have columns for each of the partners. You can create this in Excel. So first, your interest allowance based on those previous calculations, and then the salary allowance. So what's left of net income? $233,000, and that is to be divided equally. And this is why it's good to put this in a spreadsheet, put it in a chart so you can double check your numbers. You can foot and cross-foot your totals and make sure that you have allocated the full net income of $342,000 and you haven't over-allocated. So remember why this is so important, so you're updating to the correct capital balances. But do know that Rock, Binder, and Selker will be paying personal income taxes on their share of this income, not the partnership itself. And here's your journal entry. And of course, if it was a net loss, the debits and credits would be opposite, but you'd have the same numbers. Okay, now we're going to add stated ratios to this. So same example with the interest allowance, the salary allowance, but now you have stated ratios to split it. So how do you do this? What does 3-2-1 mean? Well, the balance to divide, $233,502. And how do you figure this out? 3, 2, 1. You simply add them together. 3 plus 2 plus 1 is 6. So Rock is going to get 3/6. Binder is going to get 2/6. And Selker is going to get 1/6 of that remainder. That's what the stated ratios mean. Now, as you can see with the stated ratios in this example as opposed to the prior, now Rock is getting the majority of the income because of the partnership agreement. Is this a fair agreement? It may be, it may not. Sometimes you may enter into a partnership agreement, the best of friends, and then it turns out one partner ends up doing a lot more work than had initially been anticipated and is not getting the fair share of the income. Now you can go back to the drawing board and renegotiate, change your partnership agreement, but that's up to the partners. And this would be your journal entry under this example with interest allowance, salary allowance, and the remaining split on a 3-2-1 ratio. All right, now let's say, same example, only there was only $21,500 net income. Much less. How do you split it? Same agreement, so let's look at the numbers. Start with the lower net income. It was much higher. And notice after you do the interest allowance, you would have had a negative balance. And then with the salary allowance, you have an even bigger balance. Go ahead and do it this way. This is the way you calculate. This is your source document for the future to prove that you have followed the partnership profit and loss sharing agreement to the letter. Simply take the ratios of that negative number now, and those will be subtractions. So now notice where you had a large net income, Rock had the majority, but because Rock gets the 3/6 or 50% of this based on stated ratios, Rock is bearing the burden of the lower income. And the capital balance is actually going to be decreased $13,931, even though there was a net income. So Rock actually, with a lower net income like this, with this type of profit and loss sharing agreement, Rock is going to be paying the partners out of her own capital balance. And this is the journal entry. Closing income summary, but because of this agreement, even though there was only $21,500 net income, Selker gets $34,770, part of that coming from Rock's original capital account. So it's going to depend. It may sound like a good agreement, but in times of low income or even net loss, partnerships can get into trouble, or individual partners can get into trouble. Now, to review a profit and loss sharing agreement, all it is just a way to allocate net income or loss, and there may be negative balances after the salary and or the interest allowance. Often you'll use stated ratios to divide any positive or negative remaining balances after the allowance. Now, this is not just for profit and loss, not just revenue and expense. It can be gains and loss also, and we'll look at that again later.